Hi there. My name is Craig Bassinger, and I'm the Chief Investment Officer at Richardson Wealth, and also head up the firm's asset management division. And I'm here to talk just briefly about yields, specifically what's been going on in the yield market, what's been going on from an inflationary perspective, and then most importantly, what that potential impact is for portfolios as we move into the 2020s. So perhaps the biggest question for portfolio construction and portfolio management in the years ahead is, where do yields go from here? There is no question this is the 10-year yield in Canada and the US, charted back to the 1960s. And there is no question we have been in a long-term downward trend that has seen yields essentially come down to levels that historically had never been foreseen or expected. And this has dramatic implications on the asset classes across the gambit. But I think most importantly, what we're now starting to see is that after yields plummeted to record lows during the pandemic and remained very muted, primarily due to obviously slow economic recovery and also very active monetary intervention by central banks globally, yields have started to rise up. And they've basically come off the floor here, as you can see, and come back to essentially where levels were before the pandemic started. And this is important because yields have a material impact on the pricing of just about everything, from equities to obviously the bond market, and then also to real estate and other assets. And what drives yields at its core is inflation and inflation expectations. And this is where it gets very interesting. We believe there's going to be sort of two phases over the next decade from an inflation perspective. We're currently in that cyclical upward phase at the moment where inflation pressures are starting to build. And then we believe further into this decade ahead, we're going to see potentially the rise of a secular inflationary pressures. But it's never that easy, and that's just because there are many conflicting components when it comes to inflation, prices, and yields. There is no question the reopening and the economic recovery globally has a very upward impetus on inflation. The economies are opening up. You can see here on the chart on the right-hand side that people are hopping on planes again. I would ignore the black line. That's a year-over-year number. And a year ago, people stopped flying pretty abruptly. But the orange line continues to trend in the right direction, which means more people are flying, which is a sign that we're gradually getting an opening up of the economy. And that is putting some upward pressure on inflation. And then we have stimulus, obviously unprecedented in its scope and magnitude. The U.S. just recently announced another 1.9 trillion. There's more to come. And meanwhile, you also have central banks that are very active in the bond market, essentially injecting liquidity and doing active bond buying, which is obviously also putting upward pressure on inflation. And then there's supply chain issues. Demand has come back in many different industries, but there are still supply disruptions, whether it's on the logistics side or whether it's on the manufacturing side, that are actually, holding back supply to a certain degree. And, economics 101, higher demand, not enough supply, your prices have to rise. And that's what we're starting to see now in various industries. But it's not all one side. There's some downward inflationary pressures as well. One of them is unemployment. The fact is we have 8% unemployment in Canada, 6% in the US. These were much higher, sort of 12, 14% at the peak last year, but they are still very high. And unemployment does put downward pressure on inflation because, again, many people aren't working. It makes it much more difficult to have upward wage pressures, and I think those are alleviated at this point. So that's putting downward pressure on inflation. Then we have rents or rent equivalent, or however you want to calculate it. The cost of living has actually come down for what people are paying for, and that's primarily rents and living accommodations is a huge component of the consumer price basket. It's roughly about a third. And because that has been very soft, you're not seeing, a lot of these upward pressures on inflation filtering into the aggregate numbers. And then there's productivity gains. There is no question we have all become more productive to various degrees, whether it's using a lot more technology, whether it's doing things like this as opposed to flying around the country. There are productivity gains afoot here, and that is also putting downward pressure on inflation. And current demographics, we can't forget about this. We are still in the latter stages of the baby boomers gradually reaching retirement, and that has essentially created more savers than borrowers in this kind of market environment. And if there's more savers versus borrowers, then the cost of borrowing is low because you have more supply of capital versus relative to the demand. You put all those things together, it's certainly a balancing act. We believe, we're probably going to start seeing a bit of a cyclical upturn in inflation in the near term. But the bigger question comes down to further into this decade. And this comes from a couple different perspectives. One, will the stimulus that's been put in place to sort of manage us through this pandemic, will it be turned off in a timely fashion if inflationary pressures start to rise up? And I don't know about you, but the faith in large government programs, especially that have very lagged effect on the economy in different aspects, the ability to actually stick the landing is very difficult. So that's one issue that could lead to continued upward, more of a secular, longer term upward movement in inflation. Then you've got income disparity. There is we believe in the years ahead, we're going to see increased policies to help address income disparity, which is certainly a social good, but it is inflationary because it will, bring the wages of those in the lower cohorts higher. And, you put that into the economic picture, that is inflationary. Then we've got slowing globalization. Globalization was, a deflationary force for many decades, but the pace has been slowing. And the pace has been slowing because, again, many of the manufacturing that could be outsourced already has been. And as this trend slows, this deflationary force starts to fade. Not saying it's going to become inflationary, but if you remove a deflationary force as this decade progresses, that tilts more on to the inflationary side. And then demographics. Well, demographics are deflationary right now. They are likely going to pivot during this decade as the baby boomers start to get into that household formation stage, and that's the inflationary phase of asset accumulation for individuals. That's when you finally decide that you do need two vehicles so that you can go out and drive both kids to separate soccer matches. And it's that kind of spending that is inflationary, and that is likely coming in the decade ahead. But it's not all one-sided again. If you look longer term, technology is very deflationary. Autonomous cars, very deflationary. There's other aspects that will put downward pressure on inflation. And we are now a much more asset-light society. In other words, many of the industries and businesses are just not as heavy on the fixed assets, which basically makes them much more flexible from an inflationary perspective, and that puts downward pressure on inflation. And then the mountain of debt, whether it's individual or government debt, is at these levels very deflationary. So from our perspective, we think there's going to be a near-term uptick in cyclical inflation. Longer term, which is going to fade over the next number of years. But if you push it out 2023, 2024, 2025, we start to see the risk of longer term secular inflationary pressures rising up. And that essentially leads to higher bond yields. So if we're correct, what does it mean for portfolios? Well, one thing is what's worked really well in the past decade or 20 years or 30 years may not work in the decade ahead if this is the case. We could certainly see, a return of value over growth after growth has dominated for much of the last 15 years. Bonds, which have obviously performed exceptionally well in a long declining interest rate environment or yield environment, could also have a tougher go in the years ahead. And I think what it really requires is people to become a bit more creative, especially in the defensive bucket of their portfolio. Certainly do not throw all your bonds out. Even if yields are going to grind higher or move higher longer term over the next decade, bonds have a very good historical record, even in upward yield environments, of being a stabilizer for portfolios during times of trouble. So certainly don't abandon that asset class. but certainly start to diversify it and consider alternative defensive strategies to sort of complement that core. Consider real assets, which obviously are a bit of an inflation hedge themselves as a way to diversify and sort of balance out that defensive bucket. And, I'll just finish by saying balance is key. No scenario is even close to being 100% certain. This could roll over and we could move back into a lower growth deflationary environment. That is certainly a possibility. That's not our base case. And I think when it comes down to portfolio construction is understanding what your base case is, building a portfolio that is built for that kind of scenario, but then also ensure that you have components in there or plans in place in case you are wrong, and in case things do move in the other direction, that you can pivot and make sure that the portfolio is allocated appropriately. If you'd like to learn more about the portfolio management services at Richardson Wealth, feel free to contact either myself or any member of the firm, and we would be happy to take a look at portfolios and give you some added insight into what it might look like in the kind of environment that we believe we are heading into. Thank you and have a good day.